Achieving financial success takes dedication, discipline, and most importantly, a plan. For over 30 years, Don Reynolds has helped savers define their needs, formulate their plans, and achieve their goals. From accumulation to preservation and protection, and through the income distribution phase in retirement, implementing the right strategies makes all the difference. Your retirement is our business. Welcome to Strategic Asset Preservation.
Good afternoon, everybody, and welcome to another episode of Reynolds Wrap. Joining me is my great friend and business partner, Cory Stilp.
Hello, everyone.
So today we're going to talk about a topic that we know some people don't like so much, but some people do. And I think our attitude is, and it's about annuities, folks. We want to talk about annuities because we think there's a little bit of a misnomer about annuities out there. And again, I've always said this when people come to our office and we talk about it. I think it's really the education piece of it. Mm-hmm. And so today, what we're going to do is we're going to talk about the 4 different types of annuities that are out there. And we've done this with folks lots of times. We call it Annuity 101. So to start with, there really are 4 types of annuities. There's immediate annuities. And that annuity is simply you give a dollar number to the company, and in lieu of the dollar you give them, they're going to start giving you a guaranteed paycheck. And you can structure that where it could be life in 10 years, life in 20, 10 years certain. So it all depends on the objective of the consumer at that time. A lot of people don't know that pensions are created from immediate annuities as well.
Yeah.
And, the companies go out and shop that and try to find the best bang for the buck, so to speak. So we don't really like immediate annuities anymore. They might be getting a little more attractive now because interest rates have come up. Way back in the late 80s, early 90s, when we had interest rates at, 14, 16%, I say I was an order taker because I would use an immediate annuity to help people with their required minimum distributions. And then we would get a guaranteed payout for 10 years. And it was a pretty good payout. And then they could take the other half of the IRA and they could lock that in on a 10-year contract. And they would guarantee that 7.2. And you've all probably heard of the rule of 72. And so they'd actually have 100% of their value back at the end of the 10 years. But they spent more than half of the value in required distributions over that 10-year from the immediate annuity. So that was really a great fit back in the day. But of course, with lower interest rate environment, that just didn't work anymore. So, but that's the long and short, if you will, of an immediate annuity.
Yeah. And the second part of Don's example there in the past is a fixed annuity. That's the second category, if you will. A fixed annuity is simply a guarantee of an interest rate over a guaranteed period of time. Now, most people attribute this to a CD at a bank. Again, very similar to that. But again, this is through an insurance company, and it's called a fixed annuity. As the interest rates have risen in the current environment we're in, we are seeing fixed annuities at a very attractive rates, 4 or 5% or well above that. Now, again, these will be for different time periods. You can find different fixed annuities for 3 years, 4 years, 5 years, or even beyond period time. So this, again, is a product that is going to just take an accumulated amount of money, give you a guaranteed interest rate over a guaranteed period of time. And at the end of that period of time, you would have to then reinvest that money into whatever you choose at that time period.
Yeah, and just a quick ad lib with fixed annuities, and really all annuities, if they're in deferral. So if you have what we call non-qualified money, that's one of the advantages versus a CD on a fixed annuity is you don't have to claim that growth, that 1099. We all know about phantom income we've talked about. You won't get that 1099 with an annuity. So that's another one of the, advantages with a fixed annuity is that you don't have to claim the growth on that each year until you actually withdraw it.
Correct.
So
the third category, then, if you want to go through that, the fixed index annuity, Don.
Sure, we can do that. That's similar to a fixed annuity. The only difference is the returns are calculated based on indexes like the S&P, the NASDAQ. There's so many now, Bloomberg, PIMCO, BlackRock. I mean, the list goes on and on. First Capital Trust. So there's so many different indexes now. It's almost somewhat overwhelming potentially to some folks. Mm-hmm. But if you understand indexes, how they work, for example, S&P, every day that index changes. Well, with an indexed annuity, when your contract is issued, and if you're in an S&P index, for example, the index is at 1,000, If it ends at 1,050 a year later, that would be a 5% growth on that index. And then depending how the annuity is structured, if you have a cap of 5, you would get 5. If you had a cap of 3, you'd get 3. Now, on the same token, if that index goes up 10 and you have a cap of 5, you still only get the 5. That's the trade-off on an indexed annuity because there's no downside. So that's the protection. We call it a floor. A 0 is our hero.
Yeah.
So in bad years,
Yep. You get that 0. You don't
you
lose
get the
a penny.
0, but some people see that as a positive thing because they didn't lose 10, 20, whatever the market did do.
And we've really seen the progression in these fixed index annuities to now include participation rates. So again, as you talked about the caps or some of the different ways or crediting methods to have for the money within a fixed index annuity, they have now evolved to where there's participation rates. In Don's example of perhaps a 5% growth on a particular index for a client in that year, now we're seeing options where you can, rather than having a cap or a spread, you can have a participation rate. Maybe it's a 80% participation rate. Maybe it's 100%. Maybe it's over 100% if it's in a 2 or plus year index. So there's a lot of options nowadays to have them be much more competitive on the growth side, but still give you that 0 floor. And that's the real key on why the strength of the fixed index market in annuities has really grown significantly over the last several years, because now they're very competitive on the growth side, but they do give you that 0 downside risk. And I know we're going to spend some time in the future on another episode talking about income. This is also a category of annuities that will allow some income protection for you and income potential for you. Whereas Don spoke about the immediate annuity has income, whereas the fixed annuity has no income option. This does have income options for it as well.
Yeah. And just a real quick ad lib on that immediate annuity. I forgot to mention this. With an immediate annuity, there is no more growth on your asset. I mean, you are basically relinquishing that asset for that guaranteed paycheck. And we'll elaborate in our next segment about the income and how that differs with an indexed or a variable annuity when you have income benefits. So we'll get into that in our next segment. And then finally, the last annuity is a variable annuity. I've got mixed feelings on those personally. The big thing with variable annuities is you're still in the market. And so if you want to be in the market, certainly you can be in the market, and you can do that through a variable annuity. The problem, in my opinion, is that the fees are pretty exorbitant with variable annuities. I know we didn't talk about fees in the fixed index, but generally you don't see them much more than 1%. That's kind of the high end, if you will. You might see 1.2 with certain carriers, but where variable annuities, you've got that mortality and expense fee. That's usually 1.25. And, that works differently. That's the death benefit that you're paying for. And we're not going to get into the nuts and bolts of that because all the companies work differently within those. And then, of course, you generally have a 1% fee for the sub accounts. And what we mean by that is if you were working with a broker or, an advisor, and, they charge you 1% fee to manage the asset. Well, internally in the variable annuity, they're doing the same thing.
Absolutely. Yeah. And then there can even be additional fees if you do get an income rider to it or a death benefit, as Don mentioned. You've got guaranteed withdrawal benefits or guaranteed minimum death benefits. So there's a lot of levers or options, if you will, on a variable annuity that you can purchase. But every time you do purchase an option, again, there would be a fee attached to that. So the underlying principle, again, as Don mentioned, is at risk. If the market does go down, you don't have a floor is 0. Now, again, if you do have a guaranteed income benefit, you may have a floor of 0 on those, but you're going to be paying for that. So the key with a variable annuity is really understand all of the ins and outs, all of the options, and all of the fees attached with it, because those fees can quickly add up to be 2.5%, 3%, or even higher. We've seen some fees in the 5 or 6%. So again, make sure on that category there that you're looking at the full picture, understand all of the options, understand all of the fees, and that is something that is worth paying for to get what you want out of it in that category. But again, that kind of wraps up the 4 categories of those annuities. Again, they're an immediate annuity, a fixed indexed annuity, and a variable annuity. So those are the 4 categories. And again, they all have pros and cons, but we wanted to make sure you understand them. And we'll get into in future segments more on the ins and outs and potential benefits of different ones and or income on those.
Right. I mean, again, like Cory said, there's pros and cons to annuities. It's really about the consumer and what their goal and objective is. And then, and we think we do a real good job with that and trying to fit the need. Again, if people need income, it's going to drive us to income products. If they're just looking for growth and tax deferral, we don't need income riders, and we don't need the income benefits. Some people like those, depending on the company and how they're structured. They like the income benefit because it can also be a death benefit. But then there's, again, restrictions or limitations to how that's paid out. So again, there's so many variables. And like I said at the beginning of the segment, our goal is to make sure that when we meet with folks, we want to educate. We want you to understand all the different ins and outs of the 4 different types of annuities. And then we'll do our best to try to, if you will, bring the value to you in the proper product that's going to fit the goal and objective that you're really trying to do.
Yeah.
So, and as we say with all of our segments here, we're happy to share the information with you. You can certainly call us at 651-773-3859, and we'll be happy to take your call. And, we give that 1-hour discovery meeting. We could just do that meeting on just education on annuities. There's no cost or obligation to that. So again, give us a call at 651-773-3859.
Thanks for listening in, folks. Have a great afternoon or evening or morning, whenever you're listening to us. And thanks for paying attention. We appreciate it. Give us a call anytime. We'd be honored to help you with this subject or any other subject we've talked about.
Thanks, folks. Have a great day.
Listen to more with Don Reynolds and Cory Stilp on the Strategic Asset Preservation Podcast by visiting 800preserve.com.
The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.